Have you ever wondered what really separates a professional investor from, well, everyone else? It's not some crystal ball or a secret algorithm, I can tell you that. It's a playbook, a really disciplined framework for making decisions, especially when things get crazy. So what if you had that playbook? What if you could see the exact framework that pros use day in and day out? Well, that's exactly what we're going to build together, right now, using the curriculum that shapes the world's top investment minds.
And, just like building a house, you can't start with the roof. First, we've got to lay the bedrock, which is a foundation of trust. From there, we'll open up the analyst's toolkit, then we'll get the lay of the land by understanding the economic arena. After that, we pick our building materials, the investments themselves. And finally, we put it all together to craft a portfolio that's designed to stand the test of time.
So, you might think the first chapter in a professional's playbook would be all about complicated math or hot stock tips. But it's not even close. It's about something way more fundamental. The absolute bedrock of the entire profession, ethics, and the unwavering trust of a client. Now pay close attention to that word, profession. This isn't just any job. We're talking about something more like medicine or law. Investment management is built on a promise, a fiduciary duty to always act in the client's best interest. Without that trust, the whole system just collapses.
And here's where you see the huge difference. The law? Well, that's the floor. It's the bare minimum you have to do to stay out of trouble. But professional ethics, that's about reaching for a much higher standard. It's a commitment to do what's right for the client, not just what's legal, especially when nobody's looking.
So think of these duties as essential guardrails. They filter every recommendation, every trade, every single decision through one simple question. Is this truly in my client's best interest? It really is all about loyalty above everything else. All right, so with our ethical compass set firmly to true north, now we can open the toolkit. These are the instruments professionals use to cut through all the noise and make sense of a world that is just drowning in data.
So the very first tool we have to master is risk. Now, in finance, risk isn't just about the fear of losing money. It's really about volatility, the potential size of the swings, both up and down. A high-risk asset isn't necessarily bad, it just means it's a roller coaster, right? It has the potential for thrilling highs and, yeah, some pretty stomach-churning drops. And here's that classic trade-off in action. Take a look. On one hand, you have equities, we'll call them Asset A, promising a pretty juicy 10% return. But they come with a much bumpier ride, a 20% volatility. Then on the other hand, you have stable bonds, Asset B, with only 8% risk, but offering a more modest 4% return. You want a higher reward? You have to take on higher risk. But okay, this is where the magic happens. Watch what happens when we combine them. Our expected return is 7%, which is just a simple average, exactly what you'd expect. But look at the risk. It plummets to 10.3%, which is way below the average of 14%. How is that even possible? Well, it's because stocks and bonds don't always move up and down together. That right there, my friends, is diversification. It is the closest thing to a free lunch in all of finance.
Okay, so we have our ethical code and our analytical tools. Awesome. But you just can't analyze assets in a vacuum. A real professional has to understand the entire economic arena they're playing in, that big picture that influences every single investment decision.
And that arena is always changing. Economies don't just move in a straight line, they move in cycles. From the low point of a trough, up through an expansion, to a peak, and then back down into a contraction. Knowing where we are in this cycle is absolutely critical. It tells a pro whether they're investing with a tailwind at their back or a headwind in their face. So who's steering this big economic ship? Well, there are two main pilots. You've got the central banks, who use monetary policy, mostly changing interest rates to speed up or slow down the economy. And at the same time, you've got governments using fiscal policy, adjusting their own spending and tax levels to try and do the same thing. A pro watches both very closely.
Okay, so we've scanned the horizon, we understand the economic climate. Now it's time to choose our building blocks. What are the actual assets we can use to build a portfolio?
Well, the two biggest categories are equity and debt. And the easiest way to think about it is like this. With equity, stocks, you're buying a piece of the company. You are an owner, and you get to share in the upside. With debt, bonds, you're acting as a lender. You're basically giving the company a loan and getting paid interest in return. And these assets, they trade in two very different marketplaces. You've got public markets, like the New York Stock Exchange, which are open to pretty much everyone. But then you have private markets, which is where companies that aren't listed on an exchange raise their capital. Access there is usually restricted, and these investments are often illiquid, which is a fancy way of saying you can't just buy or sell them easily on a whim.
And don't for a second think it's just stocks and bonds. The professionals' universe is huge. I mean, we're talking about tangible, real-world assets like real estate and airports, specialized funds that buy entire companies, and even natural resources like farmland and timber. The list of options is just vast.
All right, this is it. This is the final and, frankly, the most crucial section of the entire playbook. We've laid our foundation, we've gathered our tools, we've surveyed the arena, and we've selected our building blocks. Now it's time to put it all together into a coherent portfolio strategy for a client. The master blueprint for all of this is called strategic asset allocation. Now, this isn't about which hot stock to pick next week. No, it's about deciding on the long-term mix. Is this portfolio going to be 60% stocks and 40% bonds? Or maybe 70-30? Let me be clear. This single decision is the most important driver of a portfolio's long-term results, period.
But that brings up a huge question, right? With all these different assets and literally infinite ways to combine them, how on earth do you find the optimal portfolio? The one that gives you the absolute most return for the amount of risk you're willing to take on?
Well, the answer lies on something called the efficient frontier. I want you to imagine a map of every possible portfolio you could ever build. The efficient frontier is the topmost edge of that map. Any portfolio sitting on that line is considered optimal. It means it gives you the absolute best return possible for that specific level of risk. No waste.
And this is so important to remember. The job is never finished. Professional management is a continuous cycle. It always starts with a detailed plan, then moves to execution, and then enters this constant feedback loop of monitoring, rebalancing, and adapting to change. It's a disciplined process, not a one-time prediction.
So, there you have it, the completed playbook. Let's just quickly run through the 4 cornerstones. First, it's built on a non-negotiable foundation of ethics and trust. Second, it's powered by the risk-managing magic of diversification. Third, it demands a keen awareness of the economic context. Context is everything. And finally, above all, it's guided by a disciplined, repeatable process.
You know, this playbook gives us the framework, the timeless principles. But the world, the markets, our own lives, they're constantly changing. So the final question, really, is a personal one for you. How can you take this professional mindset, this focus on principles over prediction, and apply it to navigate your own financial journey?